We have a special message by Ms. Nathalie Louat, Director of Trade and Supply Chain Finance, Financial Institutes Group, IFC. Let's listen in.
Good afternoon, and thank you for inviting me to the Economic Study Conference. I'm Nathalie Louat, Director of Trade and Supply Chain Finance at IFC. I'm based in Washington, and I apologize that I was not able to travel to India for this event. In the past few months, I have had the opportunity to discuss the trends in global trade and supply chain financing with various market players at forums in Washington, London, Dubai, and in Asia. And there is a consensus among market participants that the need for supply chain finance is growing faster than ever because of the disruption in the markets due initially to COVID-19, which have gotten further complicated because of the war in Ukraine. And so it comes as no surprise that the discussion around trade financing and supply chain is coming under increased focus. IFC is the private sector investment arm of the World Bank Group and the largest global development institution focusing on investing in the private sector. Let me take this opportunity to briefly talk about IFC and its trade program, which includes supply chain financing. We launched our first program in 2004 and added supply chain finance in 2010. 12 years later, we are very active in supply chain finance in several emerging markets, and we support more than 500 banks across the globe, helping them close trade and supply chain transactions which otherwise would not have materialized. One of the key trends over the years has been the ever-increasing demand for supply chain financing. Unfortunately, significant value in the global supply chain finance market remains untapped, and the unaddressed demand is seen in both cross-border as well as in domestic flows. So you may all have heard about the trade finance gap, which was announced at $1.7 trillion in 2020. It used to be 1.5 trillion before COVID. And it represents approximately 10% of global goods traded in 2020, which is up from 8% in 2018. And despite the increased economic and financial activities, there is a higher likelihood of rejection in supply chain finance. To make it more concrete, let me tell you that we know that about 40% of trade finance applications that were rejected by banks were from SMEs. And IFC has a special focus on SMEs, which represent growth in many emerging markets. We are also at the same time seeing a price rise on imports. And price rise does not help countries who depend on imports to meet internal demand, as it costs more to import the same volume of grains or other essential goods. Food supplies needs to be replenished on an ongoing basis, irrespective of the prevailing price. In 2020, food imports represented 20% or more of the imports in 29 emerging markets, and the spike in demand and the drop in supply from systemically large countries affect price. Likewise, the breakdown in supply chain have far-reaching impact. Established supply chains are not easy to replace or substitute, and we are feeling the impact of the war in Ukraine across the globe as the supply of essentials products like oil or wheat has been severely disrupted. Price rise enables emerging market commodity exports to leverage increased export dollars for sustainable and inclusive growth, and also enhance financial stability. Commodity exporters, which we are seeing in several African and Asian regions, have gained from the highest prices of coffee, soybeans, wheat, copper. But the charts show how much increase in price we have seen. And on this slide, you can see the increase in rice futures prices in the past year. There is a significant business opportunity in supply chain financing in emerging markets. That's the way to look at it. Supply chain finance needs to grow in emerging markets to facilitate this type of transactions. And we are seeing an increasing share of the emerging markets because they are built building comprehensive domestic supply chains, reducing their reliance on imported intermediate inputs, and thereby reducing cross-border trade flows. There is an opportunity because significant value in the global supply chain finance market remains untapped. We know that supply chain finance represents a low portion of bank financing, and supply chain finance market is really largely untapped. Globally, 85% of the trade funded by banks is through traditional products. Supply chain finance is only 15% of the trade business. But really what we know is that 80% of the world trade is under open accounts, and the financing gap in this space is very large. Global Supply Chain Finance Forum, along with ICC, is championing the standard definitions for the products. It is a small but important step in addressing the issue. There is also a role to play with technology. Apart from the banks and the regulators, it is important to achieve efficiency in supply chain finance. Banks, regulators, buyers and sellers, and fintech companies all face different challenges. Banks have to learn to assess supply chain risks, which is different than what they are seeing in traditional trade transactions. For regulators, coming up with reforms to facilitate secure transactions and registries is still work in progress in many countries. And buyers and sellers face high credit and cost in the distribution and retail chains. Fintechs are growing, but they often do not have the funding to meet the meaningful demand that we are seeing in the market. So what we expect is that market will shape ground rules, new ground rules of business, and technology will play an important role. Recent trends and digital innovations are transforming the economics of supply chain finance. Easy exchange of data on the cloud, fast developing platform-based technology, new models and product solutions are emerging every day. Lenders are increasingly leveraging big data and artificial intelligence to adjust the underwriting standards, shifting from transaction and performance historical analysis. Structural changes, primarily driven by new regulation on the banks and capital management requirements, are changing how credit is delivered. What we feel is really important is that this has a direct impact on the SMEs. And SMEs represent around 90% of all firms globally. They make up roughly 70% of employment and contribute up to 70% of global GDP. We also know that trade receivables account for 40% of the total assets of an SME on average, and deferred credit payment terms is the biggest challenge faced by SMEs. Supply chain finance is one of the solutions to address this issue. Supply chain finance provides benefits to all the stakeholders, suppliers, buyers, and banks. By shifting the risk from SME suppliers to the large buyers, supply chain finance can be a beneficial tool for SMEs to optimize their working capital. Digital platforms make the process of financing virtually instantaneous, enabling bulk onboarding of SMEs and reducing acquisition costs and operational burden. Digital platforms smoothen the entire process of supply chain financing, automating financing, processing, and settlement of transactions. Platforms have also brought in the capacity to store and manage huge amount of data, which is used to identify trends and behaviors. Platforms provide better visibility to all stakeholders and can facilitate scalability. Thank you for listening to me. I wanted to highlight how much supply chain finance is an opportunity for emerging markets and can support the growth of the economies. I would like to thank Economics Time for the invitation, and we will continue to support trade and supply chain finance with our partners, especially in challenging markets with a focus on SMEs. Namaste. Thank you.